Good afternoon, ladies and gentlemen, and welcome to the Randall and Quilter Investment Holdings final results for the period ending 31st of December 2020 investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you by email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if I could ask you to give that your kind attention, we'd be most grateful. And I'd now like to hand over to William Spiegel, Chairman, and Tom Solomon, CFO from Randall and Quilter Investments. Good afternoon, or should I say good morning to you both?
Thank you very much. Hello, everyone. I'm William Spiegel. I'm the Executive Chairman of Randall and Quilter, and I'm very excited to share with you our very strong 2020 fiscal year results. What I'm going to suggest is Tom and I go off screen for the time being. We'll come back later for the Q&A part, but I think your screen will get larger as a result. So let me begin by reminding you, for those of you that know us, and telling you, for those of you who don't know us, a little bit about Randall and Quilter. So we are a very unique specialty insurance company. We focus on program management and legacy insurance, which I will briefly describe. But let me start by telling you that we are market leaders in both program management and legacy. And both of our sectors have significant secular growth. That means there's excess demand, there's fundamental changes that are occurring that are creating demand for our products. And our sectors have high barriers to entry. So we have good moats around our business from which we can take advantage of this secular growth. Now, legacy insurance think of it like a specialty insurance company. It provides capital management solutions to insurance companies that own discontinued businesses or discontinued business lines. It's a capital intensive business, and we measure our success in this business like any insurance company, but what is our return on tangible equity? And we shoot for returns on tangible equity of 15%. Conversely, our program management business is really a recurring fee business. It's more like a insurance services company or an insurance broker. What we do is we act as a conduit between reinsurers and MGAs. MGAs are insurance distributors. And we use our licenses and our ratings, and we charge 5% of the gross written premium as our fee. It's a very sticky business, and it's a recurring revenue business. The future of our business, we believe, is to grow our fee income by continuing to grow and manage third-party capital and focusing on the core strengths that we possess at Rnq, which are the strengths of insurance origination, insurance underwriting, and claims management. So let me now take you through our 2020 results before handing it over to Tom to go into more detail. So these are the highlights. 2020 can best be described by our strong operating results across our two business units, or as we like to say, it was a year of accelerated growth. So let me give you the highlights. At a group level, we had a record pre-tax operating profit of £16 million, which is a 102% increase over our results in 2019. As I mentioned, our group results are based upon our underlying businesses, and we had a breakthrough year in our program management business. We turned to profitability after just 4 years building this business, and our profitability was a pre-tax operating profit of $3.4 million. We're starting to see the benefits of scale and operating leverage in our program management business. A gross written premium for the year was $539 million, which is a 46% increase over 2019. And we're on track to get to our gross premium written of at least $1.5 billion in 2023 with 70 to 80% margins. In legacy, we had our best year ever. We did 19 deals comprising almost $500 million of required reserves. Our pre-tax operating profit was £38 million, a 46% increase over 2019, and we generated a 15% operating return on tangible equity, and our 5-year average is a strong 20%, well in excess of our hurdle rate. We continued to build out our platform, executing on our strategic initiatives. We strengthened our leadership team, and you'll hear more about this, but we acquired a 35% stake, now moved to 40% in one of our key strategic program partners, a group called Tradesman, which increased our exposure to fee-related profits. We also strengthened our capital position in 2020. We raised £173 million because we're in growth mode. And while we're in growth mode and capital consumptive, we are very focused on balancing reinvestment in the business in order to build long-term shareholder value with increasing our shareholder dividends and minimizing the need to raise external capital. And as a result, today we announced a new progressive dividend policy that we want to be very clear with the market on what we're trying to accomplish here. So our policy is that we will pay out between 25 and 50% of our pre-tax operating profit every single year. And while the payout may vary year to year, our goal is to increase the payout from the 4p per share dividend that we paid in 2020. And with that, I'd like to turn it over to Tom Solomon to go through the details of our numbers.
Thank you, William. I intend to take you through our financial results in 2020 and our business segment highlights. So turning to slide 4, the group experienced accelerated growth with pre-tax operating profit and operating earnings per share up 102% and 38% respectively. We emphasize pre-tax operating profit, operating earnings per share, and tangible net asset value per share, since these key performance indicators are a proxy of cash and include program fee revenue as written, not just earned, and exclude intangibles associated with legacy acquisitions, but also exclude realized and unrealized net investment gains on fixed income assets and foreign currency exchange translation reserves. IFRS profit before tax was $30.2 million, down 21% from 2019 due to the relative contribution of these non-cash items in 2019. As William mentioned, our 4 pence per share dividend translates into a payout of 56% of our pre-tax operating profit. We experienced strong growth by source of income and business segment. Our fee income was up 89%, driven by growth in program fee revenues, and our 35% stake in one of our program MGAs, Tradesman. Each of our core business segments grew meaningfully, including a 46% increase in legacy insurance and a profitable year in program management. Our corporate and other segment, which includes unallocated costs and interest expense on our debt, increased 48% with senior management hires during the year and the issuance of $92 million of subordinated notes in the second half of the year. Program management had a breakthrough year, becoming profitable with $3.4 million of pre-tax operating profit and a pre-tax operating profit margin of 14.3%. Fee income of $24.1 million grew 89%, driven by a 46% increase in our gross written premium to $539 million. Underwriting income on the approximately 6% of the business we retain generated a loss of $3 million. This loss is due to the purchase of stop loss coverage to protect ourselves against claims volatility, which during the year cost us $4 million. We expect underwriting income to become profitable as we diversify our business away from property-oriented programs that utilize this type of coverage, such as motor. Legacy Insurance had a record year, completing 19 deals with acquired assets of $674 million and net reserves of $500 million, a growth of 92% and 81% respectively. Pre-tax operating profit grew 46% to $38.1 million, driven by strong underwriting income associated with tangible day one gains on transactions we originated during the year. Our legacy insurance business consumes capital, and our operating return on average tangible equity was 14.8% in 2020 and 20.2% on average over the past 5 years, compared to our target return of 15%. Turning to page 8, our investment portfolio grew 28% to $1.1 billion, driven by acquired assets in our legacy insurance business. The portfolio continues to be focused on high-quality, liquid fixed income investments, with 96% of the assets being investment grade, including non-rated money market funds. The weighted average duration of the portfolio remains short at 1.8 years due to the steepening of the yield curve and a prospective view of rising rates. Now turning to our business segments. Program management is now profitable in only 4 years since our commencement of this business. Contracted premium is the amount of premium our MGAs believe will be written over time. Our gross written premium has grown meaningfully with a combination of new MGA programs and the embedded growth in existing MGA programs as gross written begins to converge to contracted premium. We are beginning to see the benefits of scale, with increasing fee income dropping to the bottom line, resulting in accelerated growth and profitability. Our program business is well diversified across products, geography, and individual programs. Our counterparty credit exposure is to highly rated or over-collateralized reinsurers. Turning to legacy insurance, you can see that we had a record year in 2020, and our cumulative investments and net reserves acquired since 2009 are over $1.5 billion and $1.1 billion, respectively. Legacy insurance is highly episodic, with origination levels and claims management experience uneven from year to year, and hence we look at a 5-year average return on tangible equity, which was over 20% to compare to our target pricing of 15%. Legacy insurance is a leading solutions provider to companies with runoff property and casualty risk. Our broad capabilities and experience are demonstrated on page 13 by having executed 119 transactions since 2009 across 36 regulatory jurisdictions in the form of both acquisitions and reinsurance. I'm now going to turn it back to William to cover our market and strategic update.
Thanks, Tom. So let me discuss our market and strategic update. I explained this at the outset, but I want to remind everybody. Our specialty businesses are key components of the insurance market. They are niche businesses, but they're now important components of the proper functioning of the insurance market broadly. Our program management is a fee business, while our legacy business is more like a specialty insurer, more balance sheet intensive. In program management, we connect MGAs to reinsurers and we charge a fee. We do that through our licenses and rated carriers. We also now have an interest in one MGA, and we may be able to develop that further. We charge 5% fees on gross written premium, and we also, from our minority investment in strategic MGAs, we have increased our exposure to fee-related income. On the legacy insurance side, we provide capital management solutions via reinsurance and acquisition to insurance companies. And we make money and generate a profit by reinsuring or acquiring liabilities at discount, managing claims, and getting reserve savings, and investing reserves in capital. We target a 15% return on equity. As Tom mentioned, we bucket our profit into 3 components: an underwriting income component, a fee income component, and an investment income component. Underwriting income is predominantly driven by legacy insurance. Fee income is predominantly at this point driven by our program management revenue, and investment income is predominantly driven by the income on reserves and required capital from our legacy business. Our fee income, as Tom mentioned, is the fastest growing component of our profits. It grew 89% last year and represents 17% of our profits, up from 12% the previous year. We expect this component to continue to grow faster than the rest of our buckets as we enhance and grow our program management business, and it continues to scale. Now, both of our markets I mentioned at the outset are large and growing, and there are structural changes occurring that should result in favorable growth for the coming years. So let me talk about each of them briefly. In program management, there are three reasons why this business is going through structural change and has significant growth. On the first bucket is the growth of the independent MGAs. Independent MGAs really are becoming the platform of choice for entrepreneurial underwriters who are leaving their underwriting businesses. The independent MGA space is actually growing over the last 5 years twice as fast as the overall P&C market. It's where all the interesting developments are occurring in the P&C space. And the number of MGAs over the last 5 years has grown by 44%. Well, this is great news. These MGAs can't grow without having support from program managers such as Rnq. The second major structural change is on the reinsurance side. Reinsurance capital is large, it's growing, but it's being disintermediated. Reinsurance capital is large, growing, and being disintermediated. What's happening is reinsurers are being disintermediated by primary companies who are holding more of the risk. How do the reinsurers get access to risk directly? Going directly to MGAs, only through program carriers like ourselves. And then the third element of growth is the fact that the MGA market broadly is about $100 billion annually. Annual GWP, which is fabulous, but independent program companies only represent about 10% of the premium. And it's currently it's the 10% of the premium, the rest of it is actually in the hands of insurance companies. And this is a real growth opportunity because independent MGAs are increasingly realizing that they need to align with independent program managers who are conflict-free and can best support their growth ambitions. So let's turn to the next slide about legacy insurance. There are significant growth catalysts in the legacy insurance side. The global P&C runoff market is estimated to be $864 billion. That's a huge market. But the issue is not the size of the market, but the addressable market. Will owners of legacy liabilities transact? What we've seen over the last number of years is a sea change in the behavior of insurance companies, viewing the legacy market as helping them manage their capital. If you think about the hard market we're in today, an existing insurance company can relieve themselves of capital in old policies by working with the legacy space and redeploying towards higher margin businesses for them. If you think about the Solvency II changes or IFRS 17 changes that will change the behavior of insurance companies, they can get rid of capital that is a drag on them by transferring it to us and redeploying. If you think about Lloyd's Decile 10, which is forcing Lloyd's companies to think more clearly about where they want to focus, this is going to push more business into the legacy market, and we're here to help. Let me talk about barriers to entry. There are real barriers to entry to our business. And given that we are in rapidly growing markets, you'd think we would see competition, and we are. But it's not easy to enter our market, and it requires meaningful infrastructure to compete. You need AM Best ratings, strong capital bases, global licenses, proven operational capabilities, and significant technical experience. We have all of that. We've been playing in this business for 30 years in legacy and the last 4 years in program management, which gives us a very large head start against any of our competitors. By the way, most of our competitors are now private equity companies, backed companies. Private equity is very disciplined, but they also have a short time horizon. And that gives us an advantage in dealing with customers who want to know that they're dealing with someone who's in a market for the long run. I want to spend a little more time on this page because given the profitable opportunities we have in front of us to grow our business and create long-term shareholder value, we felt it was very important to develop a capital and liquidity framework that allowed us to reinvest in our business and grow it, grow our dividends to our shareholders, and minimize the need to raise external capital. The framework has 4 pillars: solvency capital, parent liquidity, financial leverage, and a dividend component. So the primary, let's talk about solvency capital. Our legacy business is the primary consumer of capital. So we say here, we require capital equal to 30 to 40% of net reserves as we grow. Our objective is to target a BMA solvency of greater or equal to 150%. Our 2020 estimate is that we have a BMA solvency capital of 202%. So we're well above our target, and our excess capital is about 111 million pounds. Let's go to parent liquidity. Our legacy business is a consumer of cash as well when we acquire companies. But cash at the parent company is also used to, for example, build our excess and surplus lines company in the United States, to pay debt, interest expense on debt, or to pay shareholder dividends. So even though we might have excess capital, it doesn't mean we necessarily have excess liquidity and vice versa. Our objective is to have adequate level of cash and undrawn revolver at the parent to be able to meet our fixed charges, which we do. The third component is financial leverage. We target an optimal capital structure. We want to have the lowest cost of capital we can. We have to live within the constraints of the rating agencies and the local regulators. We target a adjusted debt to capital of less than or equal to 30%. And as of 2020, we were at 28%. The final component of our capital liquidity framework is our dividend policy. As we mentioned, we are in the enviable position of competing in growing markets with the opportunity to reinvest at high rates of return, creating long-term shareholder value. To this end, we are adopting a progressive cash dividend policy, paying between 25 and 50% of our pre-tax operating profit, which is a proxy for cash earnings. Obviously, this means that the rest of our cash and capital will be reinvested in our business, creating long-term shareholder value. While the precise amount of the dividend may vary every year, we intend to grow our annual cash dividend from the 4p per share paid in fiscal 2020. These four components of our capital and liquidity framework have to work together. Tom, I'm going to turn it back to you to talk about how we used our capital and our framework in 2020.
Great, thank you, William. As William mentioned, we are experiencing meaningful growth, and without program management at full scale, we consume capital. As shown on slide 21, we raised 173 million of capital in 2020 in the form of the issuance of debt and equity. We fully utilize this capital, net of what we generate internally, toward growth opportunities of approximately 145 million for legacy insurance, which ran across both reinsurance transactions, but also acquisitions and the use of cash. 20 million for strategic endeavors, which included the capitalization of our excess and surplus lines platform, and 8.5 million in cash distributions to our shareholders. We expect in the near term to become self-funding as we gain operating leverage in program management, which in turn will fund the growth of legacy insurance. Nonetheless, we will continue to access the debt markets to optimize our balance sheet and potentially the equity markets for any extraordinary growth opportunities. With that, I'll turn it back to William.
Thanks, Tom. So given how late we are in the year already, we're announcing 2020 results, thought it was very important to provide you with a Q1 2021 update. And our accelerated growth theme continues. So let's talk about program management. Our gross written premium grew 52%, first quarter 20 versus first quarter 21, versus first quarter 20 to 185 million. Our fee income grew 91% to nearly $10 million. We have increased the number of active programs by 21. We now have 52 active programs, and our contracted premium has increased by 80% to nearly $1.4 billion. We launched 5 new programs in Q1 20, including our first Q1 21, including our first program in our E&S space. And we wanted to highlight Tradesman. Tradesman's EBITDA, which is our strategic MGA investment, increased approximately 140% to $4.8 million. We have a large pipeline of MGAs working through our approval process, so we're expecting a good, strong year from program management and increasing margins as that business scales. The legacy insurance business also had a very good first quarter. This is a business that is traditionally stronger in the second half of the year because that's when insurance companies start focusing on their capital needs. Nonetheless, we completed one deal, a large deal with GE, 30 million pounds of reserves. We have 5 deals under exclusivity with about 120 million of reserves, and we're advancing the Part 7 transfer of our UK P&I club with approximately 46 million pounds of reserves. We're witnessing a strong level of activity in the first part of this year, again, in what is traditionally a much busier second half in legacy. So our accelerated growth continues in both of our businesses. Also thought it was important to outline where we're going. What is our 5-year strategic vision for Rnq? And our vision is to become a more capital efficient, fee-oriented, and data-driven company focused on our core strengths of insurance origination, insurance underwriting, and claims management, which requires an emphasis on 4 key initiatives. First is increasing our fee income. We are focusing on increasing our fee income by developing sidecars for legacy, by growing our program management business to $1.5 billion by 2023, and increasing our exposure to fee-related income when applicable through investing in strategic MGAs. We also want to automate our processes. In order to grow efficiently and scale our business, we need to automate very manual processes. That's not new to Rnq. That is across the piece in the insurance industry and most businesses around the world. We want to utilize digital workers for routine and manual workflow processes and allow human workers to do what they do best, which is think strategically. Third, we want to harness our data. I have an expression that every company is a data company, and that is our key strategic asset, is the unique data that we own. We want to leverage our in-house data to enhance our decision-making and improve our pricing. Can we play claims better if we know more about our data? Can we improve our legacy pricing if we know more about our data? Can we help our MGAs make better decisions? The answer is yes, in all of those cases. It's a long-term plan. And as you may have read, or I'll tell you, on Friday, we hired Rob Thomas as our group head of data strategy. And finally, no business is complete without working with its employees. We will continue and want to continue the spirit of entrepreneurialism that is the foundation of Rnq, but we want to make sure that transparency and accountability are linked to our strategic vision. Let me sum it all up in the following way. Our 2 businesses are now key components of the insurance ecosystem. One business is a fee business and one business is a specialty insurer for the time being. Our program management is a recurring fee business similar to a broker or an insurance services company. Those businesses trade at multiples of EBITDA. Our legacy insurer is a specialty insurer, and these businesses trade at multiples of book value, and it's a function of the return on equity, return on tangible equity in those businesses. And then, of course, we have capital and expenses and unallocated debt at our corporate entity. We believe the right way to look at our business is the sum of the parts, and that's more applicable today, given that we're now profitable in our program management business. And with that, let me turn it back to Mark for any questions.
William, Tom, thank you very, very much indeed. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. And once again, we will notify you by email once they're ready for your review. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. William, Tom, I don't know if you guys want to put your cameras on, and what I can do is I can take away the slides, but of course I can bring those back at any time should you require them. So just give me a scream and I will bring those up. Investors had the ability to pre-submit questions as well as submitting a number of questions that have come in during the meeting itself. But the first question that was received, if I may start with that, reads as follows. It looks like inflation is going to rise because of much looser global fiscal policies. How negative an effect will inflation have on Rnq, given it has a lot of cash assets held in fixed rate financial instruments?
Sure. I'll take that one. So on the investment side, it's a very good question. On the investment side, we've purposely held the duration of our portfolio short in anticipation of what's been a steepening yield curve, perspective view of inflation, so that we have the flexibility of reinvesting our assets into longer duration products. So right now we're sitting at 1.8 years of duration. We think that gives us quite a bit of flexibility and not significant duration risk should there be increasing rates. By purposely keeping short, we then can reinvest long. So on the asset side, we feel pretty good. On the volume side, which is where we get our business, inflation doesn't really have a material impact on the legacy side. It's really on the program side. We see inflation resulting in a hardening of the market. With the hardening of the market, we benefit from a prospective view of rising rates and inflation, with increasing premium coming our way. On the legacy side, for new deals, we see a rising interest rate environment also benefiting us, because a number of direct insurers are looking to exit expired risk in order for them to reinvest in what is a hardening premium cycle.
That's great, Tom. Thank you very much. The other question we received ahead of the event reads as follows: How do you expect a return to more historically normal levels of inflation to affect the business investment returns and the reserves required for acquired discontinued books?
Yeah, I think it's the same point, which is given we're short on the asset side and our ability to extend into longer duration, we would do that when we think we have the right sense of where prospective rates are going, including inflation. So I think we're nimble enough on the asset side to take advantage of that. And we think what's nice about our business program and legacy, in any market, rising interest rates generally is good for our business, but we tend to see quite a bit of secular growth. Even if inflation is different than what we had thought, we still see quite a bit of growth in legacy and program in many different rate environments. It's always beneficial when it's increasing. But on the asset side, even under a normal inflation environment, we think we'll be nimble enough with our short duration to reinvest in the appropriate risk.
That's great. Thanks ever so much indeed. Perhaps, I know you probably touched on a lot of the questions throughout the presentation, but perhaps if I could hand back to you to read out the questions that have come in from investors during the call, and thank you to all of those investors for submitting the questions. If I could ask you just to read out the questions and then give a response where it's appropriate to do so, and I'll pick up from you at the end.
Great. Thank you. Thank you very much. Let me direct traffic here. So the first question we have, which I'm going to ask Tom to address, is from David C. The question is, why did NAV per share decline in the year despite making a 14.8% ROE? Tom?
Right. Yes. First of all, 14.8% ROE, I want to be clear, that's in our legacy segment. That's the business that is capital consumptive, and that's how we look at legacy. 14.8 is not the return on equity for the group. But in any event, our net asset value in total did increase around 35%. But on a per share basis, really a function of the share issuance that we did in during the year. When you look at it on a per share basis, it actually decreased. That being said, we look at year over year as a 1% decrease on a per share basis when you include the cash dividend of 3.8 pence per share that was paid during the calendar year.
Great, thank you. The next question, also from David C., is about our program business. And the question is, with contracted premium almost at our $1.5 billion GWP target, will we be updating this target? And given that we are already at 1.4 and gross written, we're at 1.4 and contracted, and gross written is going to converge to contracted, how much more ambitious can you be here is the question. So the answer is that you're correct. With 1.4 billion of contracted premium, which is the premium we expect our MGAs to get us as they achieve their scale, we're almost at the 1.5 billion, and the 1.5 billion we've outlined for 2023. So I think we feel very comfortable that we're going to achieve that target, and in fact, we think we will exceed that target. The market is large, as I mentioned. It is $100 billion of annual premium. The U.S. alone, according to Aon, is $60 billion. We have probably a little bit better data on the U.S. And as I mentioned, the independent program managers control less than 10% of that. That is the big opportunity in this space, is that we're just going to be able to take more and more shares. So I think we will exceed this target. We will look to update it, but I'd rather promise and over deliver here. But we're very comfortable in the 1.5 billion. I also give you some metrics. 1.5 billion. We charge 5% fees, and we did say that our margins are in the 70 to 80% at scale, which we should be there in the 23 and not 2023 target. So very, very happy with where we're going, and thank you very much for the question. Then the next question is, why should an MGA work with Rnq rather than one of the larger insurance brokers? So I just want to clarify something. We are not a broker. We are a licensed insurance company. We are licensed in the location. We're licensed in all 50 states in the United States. We're licensed in Europe. We have an A- rating. We work very closely with the brokers. The brokers help us find reinsurance support for our MGAs. They find us MGAs that are in need of paper. And so we're not competing with brokers, they're working with us. Now, why would someone work with us? I think I went through this a little bit on the high barriers to entry slide. This is a business that your rating matters, but most of us have a rating or we can't compete. Your licenses matter, but really so does your operational capabilities. We have over 50 MGAs working with us. We have many, many reinsurers working with us. And this is about the ability to get a transaction done to help an MGA grow their business. And so we've been in this business for 4 years. We have a lot of credibility, and I think growth begets growth. So the fact that we've got over 50 MGAs gives new MGAs comfort that we can get transactions done. Most of our competitors are relatively new in the space. And as a result, they don't yet have the credibility we have. That being said, there's room for everybody. If you just go right back to my number, $100 billion of annual premium, and less than 10% of that, or 10% of that, is in the hands of the independent fronting companies. So we feel very good about our ability to continue to get business, and we're seeing that with the big pipeline we have. I'm going to go down and address the question about our program margins, which I think we already said. Program margins will be 70 to 80% when we achieve scale. Next one, and I'm going to push this one to Tom, is you're reporting year-end December results today, almost 2 months later than your insurance sector peers. Why is this, and will you bring your insurance reporting dates closer to those of your peers?
Yes, that's a good question. We report twice a year, as you know, and we are doing quite a bit internally to invest in the finance function, including the technology, so that we could just more quickly get all of our local regulatory financials aggregated and reviewed on a group basis in a quicker frequency. So where I can't commit to a specific date on when we do it is clearly our objective, as we frankly, part of our themes is automation. And as we automate finance, as well as a number of other things, I would expect that we will begin reporting quicker and more in line with our peers. It'll take probably throughout the course of this year, as opposed to expecting it to be in the second half 2021. We're probably talking more as we get into year end 2021, but that is clearly our objective, is to speed up the frequency, how quick we can report after the half year and full year closes.
Okay, thank you, Tom. Tom, another one over to you from David as well. It says, did you have adverse reserve movements during the year? How happy are you with your current reserve adequacy?
Yes. So specifically, when we think of reserves, we focus on our legacy business. And as I mentioned, our origination volume is, as well as our claims management on existing reserves, fluctuate. And that's why we look at things over 5 years. So this past year, normally we see claims redundant reserves to the tune of 5 to 10% of claim payments. That's generally what we see every year. This year we had a slight deficiency in our business. So whereas we didn't get 5 to 10% savings, we had just a slight deficiency. We think we were very prudent in the reserving that we're doing on that book of business, and we feel that our reserves are adequate and takes into account what we saw, and we got ahead of it, and that's we think we're totally fine on what we're booking.
Thanks, Tom. Another question on who are the PE-backed competitors that I mentioned. I'll just mention a few. There's a company in the legacy space called Comp Re. They were recently purchased by Cinven, big UK private equity firm. Riverstone Europe is another large UK now backed legacy company. CVC invested in them. Now, we view that as a complement to our business and our position that two very large and very well-respected PE firms have decided to enter the fray. They must see the opportunity to be large, and we all know that those groups are trying to earn significant returns on their capital. In the program space, we have Clear Blue, which is a company that I know very well. It's backed by Pinebrook, and there's a Genstar-backed company. So there's a few companies in the PE world that have also backed program competitors. I would like to also answer a question about the E&S platform. What are our plans? So this is a very unique situation in the US. There's what's called the admitted market and the E&S market. The difference between the two is just the freedom you have in pricing and the freedom you have in terms of your filings with regulators. The markets tend to work in conjunction. In a hard market, business tends to leave the admitted market and go into what the E&S market, and in a softer market, it can go back. So Pat Rastiello, who we recently brought on from Aon, runs our Accredited America business, and we look at the businesses interchangeably. They're not different. When an MGA comes to us, having the ability to offer both an E&S program or for them or an admitted program just allows us to find the best place to help them grow their business. So we're seeing a lot of growth in E&S though, because we're in the middle of a hard market. Tom, let's go to this question from Nick J. Why was your legacy return on net tangible assets in 2020? This is for legacy, less than your 5-year average of 20%. Are you seeing pressure on deal pricing?
Yeah, and that's very specific to so we had our origination was highest ever, but as I mentioned, in our claims management, we tend to see 5 to 10% savings in claims. This year we had a slight deficiency, so we didn't have historically what is roughly 5 to 10% savings. We were roughly zero on that. So we're not seeing pressure on deal pricing. If anything, our pipeline is strongest than we ever had. We believe we're reserved appropriately, and therefore that's the reason why the 14.8% is lower than the historical average of 20%.
And then the next question following up on that is, Tom, given the strong growth in program management fee revenue, how long should we expect it to take for program management cash flow to cover our legacy capital consumption? I'll take a quick stab at that, which is we're at 14% margins in program management today, and we're going to be much stronger than that by the end of the year. This is a business that has a lot of fixed costs. As I like to say, you have to lay the pipe, and then you can start growing your business, and it starts dropping to the bottom line. We should be at the 70 to 80% margins in the next few years. So we're expecting that more and more of our internal capital will cover legacy. Legacy, of course, it's a function of the deals. And we're right now seeing a lot of deals, but we're always disciplined. And so if we see excess deals in legacy that we can earn greater than 15% on, then if we continue to grow a program faster, we may need less external capital. Right now, though, we feel like we're in a good position, and it's one of the reasons we really wanted to develop this capital framework and explain it to the market and talk about our dividend policy. We want to be able to reinvest in our business when you can earn these kind of returns and these kind of margins. Another question is there an update you can give on progress for bringing in third-party capital for legacy transactions? And the answer is, we've talked about this for a long time. We think it is the right way to move the business model. It is what's happened in every single sector in financial services. It's a form of securitization, whether it's credit cards or it's auto or it's even the cat business. It is the way that groups that are strong in originating and strong at underwriting move, and they team up with groups that have lower cost of capital, looking for diversified sources of capital. We've been approached by many people in this space, and we think that we are in a good position to bring forward a legacy capital vehicle over the coming year or so. So we're, fingers crossed. There's no guarantees, but we feel really, really good about where we stand. Rachel B has a question. Can you talk about the corporate operating profit loss increase? So I'm going to kick that over to Tom.
Sure. Our corporate other is comprised of our unallocated expenses. So we allocate a lot of expenses to our program management and legacy, but there is certain expenses that we don't allocate. And the reason for the increase on unallocated expenses relates primarily to senior management hires that were incurred during 2020. And the other part of corporate other is our interest expense. This is finance costs on debt, and that went up during the year because primarily due to the issuance of $125 million subordinated debt that we did in the second half of the year.
Okay, continuing on with questions. Share price growth appears to have lagged business growth, suggesting the equity raising has diluted established shareholders. Very hard question to answer. I think if you look at a share price chart, you have to add back in our dividends every year in order to get a real sense of how our shareholders performed. So you can have a share price chart that looks flat, but shareholders have done exceedingly well, and I think that's what's happened at Rnq. I also think if you look at the last page that I talked about, our sum of the parts value, I think there's been a lot of skepticism about would we get to break even in profitability in program management. There's a lot of promises and we had to deliver. And I think we actually delivered in spades this year with our 14.3% margins and our profitability, and we see that accelerating. And I'm hopeful that we will be looked at as a sum of the parts, valuing our fee income differently than you value our balance sheet income, and we'll start to see hopefully real growth in our share price. I also think that's why we announced our dividend policy. We want to be able to reinvest and be very clear with shareholders that we're reinvesting to create long-term shareholder value. A company is valued on its distributable earnings over time. And as we build this business by investing at 15% returns, by growing our program management margins, we're creating a much more valuable company that will have more distributable earnings in the future. There's another question about, do we intend to continue dividend distributions by return of capital? And the answer is no. This dividend and going forward will be dividends, not distributions. So these are true dividends. Let's see. Is the final dividend to be paid as an ordinary dividend, but not as previously capital distributions? That's from Keith B. The answer is yes. We are going to continue to go forward, pay our shareholders in the form of dividends. I think that, there's one other question. Can you remind me the difference, Keith B., between gross written premium and contracted premium? The contracted premium, the $1.4 billion that I mentioned from our MGAs, is where we expect to be when we are at scale with each of our MGAs. Why aren't we at scale immediately? An MGA comes over, and then they move business to us over time as policies renew. So it takes time to get all that business our way. And so contracted premium represents what we expect those MGAs to deliver over a 12 to 18 month period. Gross written premium is actually what's been written. Our hope, especially with the diversification we have, is that our gross written premium merges over time with our, or converges with our contracted premium. So our $500 million of premium this year it's already on almost 200 million in the first quarter. So you can see if there's no seasonality in the business, you can multiply that by 4, and you can see we're slowly converging onto our contracted premium. But our contracted premium is always a moving number, because every time we add a new program, we increase our contracted premium. So they're two good numbers to focus in on as we continue to scale that business. Final question: was the 2020 increase in claim values to reserve values at all to do with courts looking more favorably on plaintiffs? Tom?
I can take that, William. Sure. We have, frankly, modest exposure to the business interruption cases that are out there. For those that we have modest exposure, we've reserved ourselves fully to the limit on those, and that comes from program, but it's rather small. The development that we took in legacy has nothing to do with business interruption. That was claims that we saw, frankly, in asbestos that we were just prudent, wanted to strengthen, as opposed to typically we are getting 5 to 10% savings on that. So very little on business interruption. For the little we have, fully reserved to our obligation, and legacy was not related to business interruption.
That's brilliant. William, Thomas, thank you very much indeed. I think you've probably addressed every question that's come in, and to all investors, thank you for submitting them. And if we have, for whatever reason, bypassed, the company will review all questions submitted today and publish responses where it's appropriate to do so. William, thank you very much indeed. I mean, nearly on the hour, so perfect timing. Thank you. Perhaps I could just ask you for a few closing remarks. I know that investor feedback is important, and I will shortly redirect investors to provide you their feedback.
Thank you very much. First of all, I want to thank everybody for listening. We're on a really good trajectory here. We have the wind at our back in both of our markets. We're seeing real structural changes in our sectors. We are leaders, and we are continuing to grow our fee income, which is our goal over time. We're continuing to continue to push ourselves forward. We have a fantastic employee base. We have 280 employees, was a question I did miss, in 9 offices, and our future is very bright. And we hope that you will come along with us, come along with our journey as we take Rnq to the next level of its development. Thanks very much for listening.
William, Tom, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. In order that the company can better understand your views and expectations, this will only take a few moments and will be greatly valued by the company. On behalf of the management team of Randall & Quilter Investment Holdings, we'd like to thank you very much for attending today's presentation. That now concludes today's session. Good morning to you guys in the US, and good afternoon to all the investors on the call. Thank you for your time.